Okay, it's time to begin the webinar. Welcome, and today we're going to focus on business modeling and valuation. So using the Invest for Excel Enterprise Edition, and basically we are. Let's see if I can. We will. In practice, do from scratch long-term business planning for a company. We include the final accounts of past years, the financial statements. We will model the forecast for coming years. And we will also model on what happens after the planned years. I mean, the going concern, the terminal value, which we call perpetuity in this program. We will consider investments for expansion and also, of course, reinvestments. We will take into account working capital and other changes to balance sheet items. We will include financing, debt financing, and equity. We will take a look at the DuPont model and annual KPIs. Today we will not consolidate actually, but we will make sensitivity analysis. The case today, a little bit background, is a district heating company from energy sector, a company who distributes heat to houses. And in this particular case, the heat is produced by another company. But we will also include expansion to invest in our own heating plant. And so here are the steps what we will be doing, but also we will have another Excel file which we have received from business area management that we will have as a basis for the forecast, and so we will import that Excel file into our Invest for Excel workbook and link. So I think we will switch on to the program immediately. I have it open. So here's the start screen of the program, where you can access the different parts of the program. We also have the Invest for Excel menu here on top, where you can access different functions. And you can switch also to Excel menus. You might need to use Excel menus, Excel functions every now and then. And when you have Excel menus visible, you also have access to Invest functions here to the right. But you can also switch between the menus. Okay, so I will begin immediately and start a new calculation file, because I'm making a new forecast and I started an empty Invest for Excel calculation file, and I can start by pressing this button with empty sheet, white sheet. And it now offers me 3 different types of templates. The first one is for capital expenditures, asset investments, project modeling, or business planning. Okay, now we are focusing on business planning, but I would like to combine with the business planning also evaluation. So once we have made the forecast, we can also at the same time look at the value of the business to the company. So I will select option number 2, corporate acquisition valuation, because I can do business planning there as well, but I can also look at the value of the company at the same time. The third option is for impairment testing, to test goodwill or asset values of different businesses. But I select now number 2. And it now opens the empty Invest for Excel template. And it immediately asked me to name and save the file. So, and I usually recommend to keep the in file as a part of the name, because then I know that it's a calculation file. Then there are in compis comparison file, in propis proposal file, in finish financing file, and so on. So that's why. So this is then business planning district. And when it's named and saved, it asks me how long calculation, what's the calculation term, and how detailed. I think we are doing like, I need to check, yeah, 10-year calculation. Yes, that's right, 10-year calculation. And the forecast starts from 21, like the last financial closing was 20. So 10 years from 21 forward on annual basis. We're not looking at monthly or quarterly or half-year basis. Now we are doing annual basis. And include historical periods. It's pre-selected in this valuation template. And when I press define button, I see that there's 2 years. And I guess that was the plan in this case also, yeah. The financial closing of year 20 and 19. I could include up to 6 years backwards of historical data, but now I'm fine with 2 years. The residual value is by default also in this valuation template selected as perpetuity or extrapolation. So after these 10 years, the operations continue. It's a company, it's not an asset, so it has eternal life expectation by default. So we choose perpetuity, which represents like terminal value or going concern. There are many names of the same thing, but eternal cash flows. Extrapolation means that you limit also the next phase, so it's not eternal. It can be like 10 additional years, or so you limit how long it will continue with some trend. But now I make no changes there. That's fine. So we are ready with the calculation term, and when I press OK, the program starts to create the calculation tables, and they are now created. And I now land here in this basic value screen and just give some description. This is long-term planning and valuation. Yep. And figures will be in thousands and euros. Discount rate, okay. We have decided to use the 9% discount rate. For business planning, typically you don't use any discount rate because you just make the forecast, the budget for coming years. There's no point to discount it. But now when I combine the planning with the valuation, then for calculating the value, we need to have a discount rate. And just to refresh your memory, so here is different options. Fixed discount rate, we will use that one. It's default also, but you can have also different discount rates for different periods to reflect the capital structure. By default, it discounts from the end of the year. That's how typically investment calculations are done, but here is also the option to use mid-year discounting. So then on average it will use the cash flows in the middle of the year. So this gives a more accurate result, actually, more correct. So in this case, we use it when it's on annual basis and it's company valuation. For normal investment calculations, it's not. I think it's more safe to use end of period. And also just to remind you what this discount rate is. So there's this WACC button here. So let's say, just to give a fast example, let's say your company has a cost of debt of average 3% and reduce it in taxes, and you have 60% debt out of 100 total and 40% equity, and owners want a 20% return on equity share, then it would calculate an average WACC of 9.44. So if I then just press use, then it would use that one. But okay, we had 9 set now. And we take the corporate tax into account here also. Regarding forecasting, business planning, budgeting, and company valuation. So, you know, this is a simplified version of taxes because it just simply calculates the 20% corporate tax on the profits of each year. So probably in real life you would need to switch to enter income tax manually to make your own Excel formula, because you want to also, maybe you have made some losses in previous years which you won't take into account, or there might be some other advanced things to consider. So then when you choose enter income tax manually, then it removes the formula and the protection for tax calculation, and you can do that part yourself with Excel functions. I will not do that now. Okay, that was the first screen, and I save again. Now I can save it just Ctrl+S because I have already saved it with macros. So that's why it's, when the program stops and asks you to name and save, it's good to do it because the program makes sure that it saves with macros, and then you can just use Ctrl+S to save next time. Okay, next screen is just who made the calculation and what is it about. I'm not going to fill that one now. But then the third screen is the investment table. Well, typically you would the right working order would actually be to maybe to first put the historical income statement and balance sheet, and then start planning the forecast. The investments is forecasting, but actually I made this in this order. So we will start with forecasting the investments, and then I will enter the historical income statement and balance sheet, and then I will make forecast for coming years for income statement and working capital and cash flow. Okay, so let's see. Now on this screen, I can now temporarily I can hide these two historical periods by pressing this button left to the 2019 column, and now they are hidden. And then I had a 0 point, and then first year, next year, and so on for forecast. And now we notice that on the rows that this first row is sort of reserved for the price of the shares, the value of the company, if you make an acquisition of a company. That's blue. That's like if I press the button, I see that it's selected as a corporate acquisition. So we are not going to use this row. We leave it as it is, and then we will focus on the other rows, which are categorized as reinvestments. Let's see, we have the forecast from the business area management. I will open that Excel file. Yep, there is 3 sheets. There's the investment in heating plant in 22. Then there are new rural areas that will be heated with district heating. So there is 6 new areas planned. The first investments in 21 and continues until 29. And also, so there is they have estimated the power requirement, the consumption in megawatt hours, and then connection fees, and then the investments in the new heating networks in the new areas, and also the heat distribution centers required. But then there's first sheet is volumes, and this is like the megawatt hours per year that are sold. So first there is the outcome from 2019 and 2020, and then there's the budget for 21 plus forecast from 22 forward. So now, actually, to make it a neat package, I will import this whole workbook into my Invest for Excel workbook as extra sheets. So I'm now in this Excel file, and I select all the 3 sheets. They are selected, they are white, and then I right-click the mouse and I select Move or Copy. I tick Create a Copy, and I choose To Book, Infall Business Planning District Heating Company, and at the end. So now it will copy those 3 sheets into my workbook. Okay, there are some named cells which already exist, but I can just select Yes to all. Nice. So now you see, now I have the Invest for Excel sheets, and then I have these extra sheets in the same workbook. Now I save it again, and I go back to the investment table, and let's see. What do we have? We have the expansion of district heating network. And we have new heat distribution centers. Oops, wrong way. And we have the new heating plant. And we will have new connection pipes. We will have maintenance investments. In district heating network, so replacing old pipes. And maintenance investments in heat distribution centers. Replacing old. That. And we start the expansion. So now we have the new areas sheet here included, and here is the expansion into new areas. So here is the investment amount 21 starting. So I will go back, and now it's easy. I can just simply link. Investments are minus in invest, but not in the other sheet. So I put minus, and then I just select new areas. I select the first one, press enter like that. And now I can just simply copy that formula with 2 clicks to the other period. So now that's taken care of, and then the new distribution center, same thing, minus, and new areas and distribution centers like that. And then again, just copy formula, 2 clicks like that. The new heating plant was in 22, okay. So let's see, there is heating plant total and connecting pipes total, yes. So this one, well, I could just put the values, but I will link this time. Minus 963 and minus 739. Yes, okay. And then we have the maintenance investments ongoing every year. Did we have them here also? No. So I guess they should be just entered. Oh, okay. Yeah. Okay, so it's minus 300,000 in 21 for district heating network, and it's minus 150,000 heat distribution centers. And both of these will continue every year with the 2% increase, like inflation, so to keep the same level. And I can select 2 cells at once and then just distribute the value with the 2% increase. So that's fast. So now it's just the depreciations. And they were defined that for district heating networks, it's 50 years. So that's the first one, district heating network. 50 years. Straight line depreciation, machine equipment. Begin depreciation. Well, here is one trick that we could be using now. Typically, like district heat networks, when you invest every year, so you invest during the ongoing year, and so on average, if you start depreciating when it's ready, on average you depreciate 6 months, half a year. So I can select first year depreciation equals 6 months and use consecutively. That means that for every year's new investment, it's depreciated for half the year for the first year. So that's really neat, good functionality available here. And let's see, I can choose I don't need to make every row separately. I can pick all the district heating networks. There's another one, but that's all. But anyway, 2 at the same time, okay, like that. And then we have the heat distribution centers, 25 years. Same thing, 6 months used consecutively. And there is one more row, I guess. That one. Yep. And then we have connecting pipes, 40 years. isn't that the same as distributing network? No, it says 40 years, okay. 40 years, 6 months used consecutively. I guess that's the only one then. New heating plant. Oh, it's also 4%. Okay. It's for the new one, yeah. 25 years. Gives 4%. 6 months used consecutively. Okay. Now it looks all good. So we have included all the investments, new investments and maintenance investments. I'm saving the file and I move forward to next screen, which is income statement. And I will start with the historical period. So I will now press the button again to show the two historical periods. And we have 3 types of incomes. So we have variable energy incomes. We have fixed energy incomes. And we have connection fees. And for the variable energy incomes, we use sub-rows to model it. 4 is enough. We take the volume in megawatt hours multiplied with average price euro per megawatt hour. And then we need to recalculate it to thousands. So divided with, okay, well, let's call it divided with 1,000. And notice now that something that doesn't look so nice happened, because now it's dividing with 0 and it's not possible. So let's already now put the 1,000 here and immediately distribute it to all periods. So although here is the 0 period, it doesn't matter. We can still just press to distribute button, the program will put it automatically. Now when there is the 1,000 in every column, there is no divided by 0. It's always divided by 1,000. So no problem anymore. And then there is, okay, for the last row, let's remove the operator. We just want to have a price change multiple here. This row. And it will be 1 here. So let's see, for the volume in 2019, I will again link to the volume sheet in this case and take it from there and just copy, and we have, and then average prices, okay, they were 43 for both years, 43. And for fixed energy incomes, let's by the way make this with 2 decimals and distribute it. Fixed energy incomes, we also need 2 rows. Yep. We have the fixed energy incomes, but then we also use a price change multiple here. And that was also exactly the same for both years. And the multiple was 1. Let's again make it with 2 decimals and distribute. We will adjust it then for coming years, but for now, a connection fees, okay, we don't need any sub rows. It was 235 here and 57. This is just what was the outcome. And we have the net sales turnover here for. And by the way, please also remember that you can rename rows. Like if I want to call it net sales or turnover or revenue, I just go in here, top left in this blue button, and I edit 3 row text. This is available on this all these screens, so you don't need to settle with what we call rows. You can always rename them. Let's call it revenue this time, just as an example. And okay, then costs. Again, we have the heading variable costs. There could be maybe it could be costs of goods sold. Let's rename it. Here. COGS. And the items we have here is purchase heat, variable cost, and purchase of heat, fixed cost. Yeah. And we have heat produced in own heating plant. So I just wrote over the headings suggested by the program, and also delete that one. Now there are many empty rows, but we will then just with one click we can then just hide the rows we didn't need. But let's leave it until later. Leave it until later. And now for the heat of variable cost, we need sub rows, even 5. Okay. The first 5, so that's fine. And let's see. Okay, now we assume that in this business it's reality. We produce and sell the same amount of so and in this particular case it's purchased, and therefore another one who produces as the heating plant and produces the heat. So it's purchased heat. Purchased heat megawatt hours. That's of course now equal to the amount delivered. So I link up to the volume sold. And well, actually this will be true for all the periods, so with some adjustment later. But let's start by just copying the formula to all periods, so it's already set for coming years. And now I'm changing the operator from plus to multiplication. We need to have the cost per megawatt hour. Cost of heat euro per megawatt hour. And it stayed the same for both years. let's make decimal. Like that. So now there's the cost. But then there is also some heat loss. And this heat loss is by contract 10%. So we put a multiple of 1.1. We need to produce, we need to buy more heat than we sell actually, 10% more. So because of heat loss. And this stays always the same also. So I will just simply distribute the value to all periods. And then again, we need to divide with 1,000 because we have in 1,000 euros this calculation. If we didn't have in thousands, we wouldn't need to do this. But when we have it, we need to. Okay, now let's call it in the now. Y. Then put the 1,000 and distribute it 2 clicks like that. And then we still need, I remove the operator with last row, and then we have the price change multiple. Which is 1 there. And okay, let's make this in also 1 point. And distribute it also. Okay. The fixed cost is just to be entered minus 363. We didn't produce any own heat in the past year. This will be later from 22 forward, or 23, I guess. Investment is 22. All right, so that was the cost of goods sold modeled for the 2 past years. And then we have the fixed costs, which include we have personnel cost, we have other external costs, and we have other operating costs. And the personnel costs were okay, extremely low. And other external costs, minus 141. And other operating costs were minus 69 and minus 7. Then we had also, of course, depreciations. And depreciations were minus 301 and minus 321. We had net financing income and expenses were minus 40 and minus 42. We also made a group contribution. there. Let's name it. So contributing of profits to the owners within the group. So, okay, we should land that. Okay, there was depreciation in excess of plan. Minus 640, minus 155. So the point is now, so all the profit is transferred to the owners. So the net income is 0 for both years. That was how it was run. Anyway, now we have concluded the historical income statement. I saved, but we still need to do the balance sheet. So I jump to input balance. Below the heading balance sheet, there is two buttons, and the second one, the gray one, is to open all sub-rows for input. So let's see what items we have here. We have some immaterial rights, 48, 47. And we have some machine and equipment. So we don't have that, not that, not that. Machine and equipment we have 7,091,000, 7,482. No buildings either. No land and water. We have some prepayments and constructions in progress, so we put 1,526 and 2,183. No other tangible assets. No investments in associated companies, no deferred tax assets, no long-term loan receivables. Okay, we have some small other investments then. And then we have inventories. No, we don't have inventories. It is not stored. But we have accounts receivable 250,000 and 300,000. Other receivables 796 and 481. Now we have the assets total in balance. It's 10,503,000. And then now this the asset side is entered except for one thing, the depreciations. We need to define here how the opening balance assets are depreciated in the coming years. And in the case we say, okay, for immaterial rights, choose method enter. So instead of straight line, we choose enter. And we put, okay, so it's for small amounts, so it's minus 0.5, it's 500. I can use decimal again. And I distribute, it should be the same for all coming years. So I just simply, okay, I don't have distributed in balance sheet. So I need to copy it manually in this case. And then we have the machinery and equipment. Same thing, we choose enter. And put minus 320,000 for for all years. And then we have these prepayments, construction, choose enter again. And there's a plan which is -17, 21, and -66 for the rest of the years. So again, I manually distribute like that, okay? And investments are depreciated. So now I'm ready with that side also. And let's save, and let's yeah. Let's go move forward to the shareholders' equity and liabilities side, and I will enter the opening balance. Well, okay, actually 2 years. 230, 34, and 764 in retained earnings, and those will be the same because all earnings are given out, so it doesn't change retained earnings. Appropriations, we have 6,395,000 and 6,550. And interest-bearing long-term debt, we have 1,350,000. Changes there. And we have accounts payable 250 and 300. Other interest-free short-term debt 698, 1275. So now the total should be same. There is a check also, but it only shows in level 5. So, but you see the check is 0, so they are in balance. Okay, so now we have also entered the historical balance sheet. I can now, by the way, choose to close to get a better overview of the balance sheet. Yep. By the way, here there's blue lines, which is like if this would be an acquisition of this company, then how it would show, what changes would show up in the buying part, the group balance sheet. But so we don't need them now. So we can also simply choose to hide them. We don't want to have extra information. So I just select the group rows to be hidden. Like that. So now, okay, to open that one. That was not the meaning. No. Yep, like this. Now I have a better overview of the whole balance sheet with no extra items. And of course, now there is no changes, but when we model the income statement and the working capital statement and the cash flow statement, so all changes to balance sheet comes from those. So you only enter historical balance sheet, but then there's nothing to be entered here in the balance sheet. Only changes now is depreciations, which we already defined here for the opening balance. And of course, it also shows, let's, by the way, if I open these tangible assets and machinery equipment. So, okay, here is the old assets, which are depreciated here. But then here is also showing up the new assets where we the new investments and reinvestment that we make. So they will of course also show up here in the balance sheet, and they will also be depreciated. Depreciation show up in the income statement. Both depreciation show up in the income statement. So this is like in the net book value, of course, always automatically. Okay. Yeah, we are ready. So we will now continue with the forecasting. We already made the investments, but we didn't make the investments are forecasted, but not the sales and operating costs, cost of goods sold. So let's continue with that. So we have the forecast from business area management for volume. So I just again link to volume sheet and to 21, and then just copy distribute that function formula, and then we have it. And what about price? Okay, yeah, we can use the multiple. So we budget 5% high, we increase the price with 5% for 21, and then we plan to increase again with 3% in 22, and then from that point forward, I think it's 2%. Yeah. So I put here 1.02, and now because I already have used this copy distribute, so it's automatically then continues to stay the same. So okay, so we have a price level increase here in 21, and also more than normal in 22, but then we just stay with the inflation, basically assume inflation of 2%. So now the price can be calculated with Excel formula. It's previous price multiplied with the price change multiple. And basically that would be good now just to copy, but because here is this empty column, which by the way can be hidden anytime. It's if you don't want to include it, actually we don't need it at all. So let me show you. I go back to basic values, to the calculation term here in basic values, to calculation point button, and here you see there's a 0 period and it's included, but if I remove the tick, then it's not included. So now the sheet will look more compact. You know, it's very important in normal investment calculations, but now you just see that by color that those two are historical and this is forecast, and there is nothing in between. But still, it's just hidden. The column is there. So when I now copy this cell to next, it's wrong because it takes the empty column. So I need to adjust it so that it takes from I column instead of H. Like that. And now I can copy the formula all the way, like that. And well, actually, these price change multiples will be always synchronized with the sales price. So I can use the what happened? Oh, I took wrong. I want to copy the formula like that. And same thing here. Like that. And the fixed pricing also follows the same. Okay, but it's also depending on volume. Yeah. So we need also to reflect the changing volume in the fixed energy income. So we will make Excel formula. I will take into account the change. So it's that one divided with that one. Multiplied with previous year's fixed income and multiplied with the price change multiple, like that. And that's good, and I can copy the formula, except now I again had a problem with this column in between, so I need to fix it. So this is I, and this is I, like that. Now I can copy the formula. Nice. Connection fees, okay, they should come from let's see. Yeah, connection is always when you connect to a new customer, so it's only for new areas. So we take it from here. I will simply link there. So equals that one. And now just copy the formula. Nice. Okay. So now we have modeled the planned incomes. And then we need to do the same thing for cost of goods sold. And the cost of heat is 6.9. Oh, I guess it's the same price change multiple. All right. So it's that one multiplied with that one. And again, I need to make a correction on this row. I and distribute the formula, copy the formula. Okay, that was easy. And then I guess this one should be probably modeled the same way as this one. I assume that. So I take this one divided with that one and multiplied with previous year fixed cost and multiplied with the price change multiple. Could that be correct? Where do we have values? Yeah. That's a full year. Yeah, it should be correct. And again, I need to adjust it for this one empty column. So H2I and copy formula. And then we have the new own plant. We have, okay, it's operational from 24. So we need sub rows, 4 of them. And again, it's the produced volume. Megawatt hours. Production cost. Work per megawatt hour. Heat loss multiple. And divided with 1000. So plus volume multiplied with cost multiplied with heat loss multiple and divided with 1000. So let's start by putting the 1000 there to get rid of those div O's, and 24 is first year and production is it's not here. Oh, here it is. 24. 380. No. 633, of course. Okay, we need to wait a minute for Excel to recover. It's trying to do something now. So just taking this opportunity to comment. So as you notice, I'm really doing this hands-on and not explaining so much around it, but I want to show in practice one example on how you can do the budget and forecast, long-term forecast for a company. So and I'm not taking shortcuts, so I include like unnecessary items just to make it realistic. So because that's how it always is. There is many complex things also to consider. 633 is the one. It's a produced volume, and that will, I guess, stay. No, it will increase. Okay. Yes, it will increase. Okay. So then it should be linked. I will relink it. I don't know why. This part we save. Then link and new areas and 633 like that. Now there's no delay. I don't know why there was a delay. Now I just copy the formula like that. Okay, fair enough. And the cost minus, we had it here also, 40. And then with 2% inflation. So not copying the formula, but distributing the value of the active cell with 2% increase and make it visible by putting it in the D column very visible. Because this 2% here, when it's visible, so it's dynamic, so I can just change the number and the numbers change. Like that. Okay. Heat loss multiple is this 1.1 again, 1 decimal. And distribute. Okay, now we have the costs for heat produced in home plant. It's partial. It's not all the heat needed. It's partial, but we need to adjust now down the purchased heat. We don't need to buy 66,020 megawatt hours because we also produce 633 megawatt hours. It's only 1/10, but anyway, we need to deduct it. So minus own production. So now it's slightly lower, and I need to copy that formula forward. Now it's adjusted for own production. Majority is still purchased, but 10% is produced, a little bit more even. 15% produced on your own. Okay, I guess that were the costs of goods sold. Save again, and then go to the fixed costs. And what does the case say about fixed expenses? Okay, there are some technical services which I can call them external costs. Minus 21. Plus other external services. Okay, so it's minus 138. Okay, I should separate. Let's make it separate. I should add one more row. We call it technical services. And they were minus 20 in 21. Okay, it was one-time thing. Other external services was minus 118, growing 2% annually. Other operating. Okay. So this would be for the new plant. And then there's, okay, so there's maintenance cost for the plant and the new maintenance, new connection pipes. Okay. So let's use two sub-rows here. And although we already entered here values on the sum level, it doesn't matter, the program automatically puts them on the sub-row. Should I use 2 or 3? Well, I just use 2. No, I use 3. So this is just other operating costs generally. This is operations and maintenance of heating plant, the own plant, and operations and maintenance of connecting pipes. And those will then start from the year first operating, that's 24, I guess, yeah. So here is the first year, and it's 2.1% of the investments costs. Okay. Okay, minus 2.1% multiplied. Okay, that was not a minus. Sorry. That's a minus multiplied with the investment cost of the heating plant there. It's 20. Yeah. And then growing with 2% annually. So now I just distribute the value of that formula with 2% growth like that. And for the connecting pipes, it's 2%. No, it doesn't say. 1%. 1%. Minus 1% multiplied with the cost of the connecting pipes there. And also with 2% inflation. Distribute the value of the formula. Like this. All right. Did it. Yeah. So that's it, and we go slightly down, and we see that the depreciations are automatically there. They are partly from balance sheet of old assets, and majority is from investments made in investment table. So they show up here. So we have a EBIT here, and then we have financing items. And we will also include financing here for the coming years. But we will come back later, I guess. We need to first plan how much debt we need, and then we calculate the interest cost here. So we are basically on, taxes. We don't bother about this group contribution, and taxes are calculated automatically. So now we see the net income without interest expenses still looking good, making a million a year profit. And now I can hide the rows I didn't need. So look here, top left, blue button below income statement heading, select empty rows. With one click, it selects the rows I didn't need and press OK. And now it's more compact. And remember the flip buttons, you can also open and hide sub rows always. Or you can use this leveling two or three are like short levels. With level 4 you have one sub row level. With 5 you have 2. I didn't need 2 here. I only used 1 so far, I guess. Yeah. Okay, we will be needing later. All right, we have now made the forecast, the income statement. Let's continue to working capital. And first of all, accounts receivable. So you see what the accounts receivable was the previous year, and you also see what the average term of payment. I mean, if you calculate the accounts receivable per last of December divided with the whole year's sales, so it corresponds to 27 days. What does my case say here? Okay, it says that we use 30 days for planning purpose. So now when I enter 30, it calculates 30 days of sales outstanding at the end of the year, 377, and I distribute this 30 to all periods, and it always calculates automatically the accounts receivable. We don't have inventories. We don't store the heat. It's possible to do it, but we don't have that technology. Then we have accounts payable, and we see that it has been slow paying. And then, okay, we seem to assume to continue. So we enter 40 days for customers to pay on average, and then it calculates the accounts for us to pay. It's us to pay to the suppliers. Yeah, that's right. Other change in other current liabilities. Okay, we don't plan any changes here now. So this is then the working capital, and actually it's actually looking quite good. It's negative. We have more liabilities than receivables. So our suppliers finance our operations and a little bit more. So this is a good situation. Okay, that was easy. Then we have already the cash flow statement. So we have an overview. We have the incomes, we have the cost of goods sold, we have the fixed cost, we have taxes and changes in working capital. We have the investments and the free cash flow. Because of big heavy investments here, we have a negative free cash flow for many years, but then at the end it has stabilized, and we can make the valuation based on a more stabilized cash flow. And we see that there is definitely a need for financing because the bank account is minus 1.2 million, minus 4 million at the most here. No, even more, minus 5. So this needs to be covered with debt. And let's see what the case says about debt. The company's free cash flow is negative because of continuous investments. This requires some financing to be planned. We will raise 50% debt of investment costs during years 21 to 28. And then after that, we will amortize the debt with 850,000 euros per year from 29 forward. So the rest should be equity, 50% debt and 50% equity, I guess, then. Okay, so we have here, in the lower part of the cash flow statement, we have financial cash flows. We have a button for long-term debt increase and decrease, and we have a button for equity increase and decrease. So let's assume then that 50% is equity and 50% is debt. I can start with the equity. And I use this row changes in share capital, although it doesn't need to be that there is new capital raised. It just means internal financing. I could rename it to internal financing. But don't bother now. I just put the formula. So equals 0.5 times, and I take the investments row here. Oops. And I think I need to use minus sign also because to change the sign on that line. Just not percent. Huh. We don't need it there. We have that much money. We only need here. From this point forward. We are still fine here. Because if you look at the balance sheet, we have, why didn't we enter bank and cash? Okay, there was nothing like it. There must not have been any bank and cash. Still we are fine here. Oh yeah, no, it comes from the working capital, I guess. Change in working capital. And we have good cash flow. We have enough cash flow to cover the investment. That's the whole thing. So from 22 forward, let's put 50% equity, 50% debt. So minus 50% multiplied with investments. And now I can just copy that formula all the way. And then I do the same thing with debt increase is plus. So same way, minus 50% multiplied with investments. And what did it say? How long? Until 28. Okay. And then amortization minus 850 each year. We take more debt every year because we continuously invest more, and then when we stabilize the operations, no planned expansion anymore, so then we start amortization with 850,000 per year. Okay? So this will automatically be reflected, both of these, of course, in the balance sheet. So we have the long-term liabilities here growing. Short-term liabilities also automatically change because, well, only here at the end, because next year's amortization is always in short-term liabilities. It's called current portion of short-term loans, of long-term loans, of course. And okay, so let's see. We have the interest costs to be modeled. They will show up here, but we can model them in the income statement where they also show up. So now I go to the row for financing income and expenses. Let's use sub rows here. 3. Was from previous years, but then for coming years we will have the finance income. We can also model like interest income on liquidity, liquid assets and financing costs. And I will use sub-row, so I now go to third level. I select the same button. I choose the row financing expenses and create 2 rows, I guess. Interest percentage. What are we supposed to be using? 3%. Format as percentage and distribute value. Of course, these can. Like that, and multiplied with average debt here. And but we will do it from 22. Yeah. So now I need to have the loan balance here. So equal, but I need to take like this year plus previous year divided by 2 to get the average balance, and I also need to take into account that there might be also the short-term portion of long-term debt. So yeah, so I will, yeah, in brackets, and I go down to balance sheet. I'm in 22. So we have, I need to open those first. They were closed. So let's go down first to balance sheet so I can select the correct rows. They should be open like that. Because I only want to take interest-bearing long-term debt and interest-bearing short-term debt, so not the interest-free. So now I can go back and start again. 22 equals, and I go down, and I select interest-bearing long-term debt 22 plus current portion of long-term loans. That one, which is 0, but it will be at the end, so I need to take it into account already. Divided with parentheses that one plus that one. No, not divided. Plus and then divided. Oh. Actually, I could have them all in one row. I should have had them all in one row. Let's make a change. I'm making this on the go, so but now it should be correct. Yeah. Long term plus short term from current year and previous year divided by 2. So that's the debt amount. And I can just simply copy that formula to us. Now it's automatically calculating, but it should be minus. So this is the mistake I made here, like that. Okay, now we have the financing expenses calculated automatically here. Let's say. And let's look at the cash flow statement now. So now we also have the financial income and expenses here. In the lower part, they are not changing the free cash flow because that should be without financing. And then also the same, the tax effect. Whereas we have the other taxes here, but the tax effect from financing shows up here. So actually what we see in income statement is the sum, the net of these two. So we don't have 358 in the income statement, we have 358 minus 27, if you look at 24. 24 and taxes, 24 and, where are they? There, yeah. So you see, it's the net. And yeah, basically this is sort of, let's see, do we have enough? Yes, we have actually we could have amortized a lot sooner, but this was how it was given in the case. But of course, what we don't have is we don't have these dividends here yet. So if we could model dividends here, and then we will not have as many. Maybe we could do it. I mean, but this is business planning, so why not make it? We are actually sort of in time, so If you want to have dividend, let's say you want to have half of profit. Changes in retained earnings. Let's put minus 50% multiplied of. Oh, let's. By the way, now when I face this problem that I want to link to something which is above and I can't get there because there's this ceiling, this button with the picture of a sheet, you press that one, now it's open, now I can move around freely. So now I can make that formula, finish that formula. What should be previous years? Profit actually. So I take net income like that. And then I just distribute again. But you see now when I want to distribute that formula, I don't have the button because I don't have that ceiling. So that's why it's good to put it back on. Then I always have access to the functions. That copies the formulas. Now it also pays out dividends. And now you see that there is not too much, a little bit too much excess cash, but I mean, this could be adjusted, of course. Anyway. Just this is how you would make dividends. And then, okay, so we have now concluded the forecast. And now we can look at the valuation of the company. Look at the result sheet. So typically this is of course used for investments to see payback time and internal rate of return and net present value. But this is like a little bit same thing. So we have the required rate of return for the valuation purpose is 9%. So if somebody would require 9% return of the when they buy the company, then they would, this would be the maximum price to pay. But before we look at the value, let's make some adjustments. So we have modeled 10 years, and the present value of cash flows of those 10 years is 11.1 millions. Then we have a residual value of 6 million. But how is that calculated? That's the interesting part. So here to the left there is a button. Press that one. It now opens some cells for adjusting what the trend will be after 10 years. What will happen after 10 years? The default is that it takes the last year's free cash flow, which was 1,293,000 positive, without any growth, forever. Now I could limit it to, let's say, other additional 10 years or additional 20 years or whatever. It would then reduce, of course, the residual value. But by default for company valuation, perpetual is used for terminal value. Now, if this is not a normal year, I could change to choose some other year as a basis if it represents better normal year. But I can also make adjustments. Let's say if you need to make bigger maintenance investments like every 5th year, and it's not on this year, so you can now, of course, reduce the average annual wear and tear of assets from that cash flow, so that you sort of divide that every 5th year happening maintenance investment by 5 and put it on an annual basis. Then you choose there and put the formula here. And also, of course, you can have growth. We assume the 2% growth normally, so why not assume continuous? Now when I enter 2% growth, so this increased a little bit. And I can also check, I mean, it now calculates at the end of 2030 that at that point, the value of the company, I mean, the cash flows after that would be 2.5 million, which represents roughly 9 times the EBITDA of 2030. So this divided with EBITDA 2030 gives the multiple 8.94. Now this is like to compare with other transactions of companies, like it's like indicator on if it's expensive or not. So it's like 9 years of EBITDA would repay, basically. Okay, I can now hide that one if I'm happy with that forecast. So we have 11 plus 8, 18,000, or 19,000 almost, present value of cash flows. And here then is deducted the present value of reinvestments. We make a lot of investments during these 10 years. They should be deducted. This was operative cash flow. So we have here deducted the investments and the present value of investments. So now the value of the company is only 5.6 million. And we also still deduct the interest-bearing long-term debt in 2020, actually. Because it needs to be repaid. And then we land on a valuation of this business of 4.3 million euros only, which corresponds to a 3.5 times EBITDA of 2020, which is really low and sort of reflects the heavy investments here, I guess. Okay, just checking it's so low, but it's perpetual and it's based on normalized 2% growth. So yeah, this will be then the value based on these assumptions, but and then everything paid above that is sort of extra. But of course, again, you can have a buyer that uses a multiple of 8. So, and then you can calculate 8 times the EBITDA of 2020, and then you get a higher price. Let's do it, by the way, Justin. But of course, it's the reason why so is because they need, it's not just the purchase of the company, but it's the additional investment which are really heavy. Let's see. Oh, I'm not income statement. No, let's go to income statement. EBITDA 2020. There. $9.7 million. So, but it's because it's the one that purchased for 4.3 million would also have to pay additionally almost 20 million in investments. So that's why it is low. Okay. Okay, let's see. For the last 20 minutes, let's look at some analyses, which we have really nice ones here. Let's start with key financials. So in this key financials page, which is empty, there is a new button. Here it's a percentage sign. And when you press it, you open this selection of annual KPIs, which are available here in the program. Now you can select whichever you want, but I'm selecting all now. And you can select from which row it will put it. If you can have your own additional KPIs here also, of course, you just name and make an Excel formula. But then these are the standard KPIs, and so now they are included there. So there is showing like how is the liquidity developing really nicely, and it's good. Only here is a little bit tough. And then you have turnover ratios, your profitability indicators, your business risk, financial risk, and stability. So, and all of these indicators are explained. If you put the cursor on the red dot, there's the explanation in words, like this: return on net assets, operating profit before tax, EBIT divided with net assets average balance. And you can also check it by just clicking on the formula, and it will show which cells are included. And then we have, I don't have time to go in detail to these KPIs again, but they are general, so you can Google them. Then we have something we call the DuPont analysis, which breaks up the return on assets and the return on assets and equity. There is two versions, the short and long version. So the upper part, the return on assets, so this the calculate, it's always for a specific year. You choose which year, because it's an annual KPI. So for 23, there is 6.6% return on assets. So how is it calculated? It's a profit margin multiplied with turnover of assets. Okay, the profit margin is calculated from net profit divided with operating income, that's revenue, net sales. So 1 million divided with 5 million gives 20%. And again, net percent, how it is calculated, you can go back here, and how EBIT is calculated, you can go back there, and how operating expenses calculated, go there, and how gross profit. So you can really break down it. That's the first half. The other half is the assets turnover, which is really low. But this is, again, typical for this industry. Heavy long-term investments. So only 1/3 of the assets are turned around during one year. So and that comes from, again, revenue divided with how much assets. So it's 3 times the assets compared to the revenue. And it's fixed plus current assets, and here you see how the current assets are calculated. So that's return on assets. But then to calculate return on equity, you combined return on assets with leverage. So including debt in the company gives a leverage on equity, because debt usually costs less than the required return on equity. Or you put less equity than debt. In this case, you put 50-50 actually. But anyway, so 6% multiplied with the leverage 3.4 give return on equity 22.7%. Okay, but how do we get the leverage? Okay, it's the total equity plus liabilities divided with equity. So equity is only 1/3 again of the total equity plus liabilities. And here you see how they are calculated, how the liabilities are calculated and how equity is calculated. So this really helps to understand how profitability is built up. Furthermore, okay, we have a lot of different analyses, of course. One is, of course, sell break even. Okay, I can't do it here. I need to go to, let's go to income statement and select some price is, of course, one and volume is another. Let's select price. And maybe we assume that we know for the next couple of years the price, but what happens after then? The world can be surprising sometimes. And let's choose, I will choose now this price change multiple as the changing factor. So how much lower price we can, yeah, if the trend changes and district heating is no longer like the first option, and you need to slowly start lowering prices to manage to cope with competition, like geothermal or solar power, or so need to start lowering prices. So this is the minimum the maximum lowering that you can do, 2% annual actually. Then you end up with NPV 0 and return 9%. And then you can just simply do under break even. And you can do break even on any input variable basically. And then of course you have all different discount factors, like different sensitivity analysis, ready-made charts. So now this is sort of interesting now, because now it reflects how the discount rate would impact the value of the company. So now this is quite interesting actually. The lower discount rate, the higher the company value. So only going from like 9 to 7%, the value of the company doubles. So 20% lower discount rate, 100% higher value, and vice versa in the other direction. And you can of course enter here any values. Let's say if you use 4 and 6, 10, 11. Then I press exclamation mark. So now it updates. So now you see with the 4% discount rate, the value of the business would be 40 million. So, and also maybe this 9% then was also too high. I mean, it's pretty stable monopolistic business. So you can settle for lower discount rate. Okay, enough about that. Then let's continue. Next one is also interesting because we have heavy investments. So okay, well, the investments also impact the incomes. So in this case, this is more like, what if we can do the same capacity increases, but at lower cost, 10% lower cost, 20% lower cost, or 10% higher cost, 10% higher costs. So this is more like a price level of investments. If we make the same capacity, but at a lower cost or higher cost. So there you see how it impacts the profitability. It's like a COP indicator on investments. Then okay, and this is like a price simulation of the cost of district heating per megawatt hour. So if we take 10% higher cost for customers, value rises from 4 to 10 million, 20% higher to 17 million. But again, we can't take 10% lower So, or not 20%. So we don't have that much margin. Let's check a little bit here. Let's put 1 and no, -1 and -2, +1 and +2, and make it a little bit more tight. So now you see like 1% change, 2% change in pricing in both directions, how it will impact the value of the company. And you also can choose indicators for any selected year. So in the middle is, in this analysis is the planned case, but then it's the worse and better. So in this case of pricing, with just 1 or 2% change. So here are the standard indicators available, but here is also, of course, all the indicators available that we have included in the model. So you can choose any year. And then the next one is the cost of goods sold. 10% higher cost is okay, but 20% is not okay. And also, again, if we can save on the cost of goods sold, the production cost or purchase cost of heat, so then it really would increase the value of the company quite a lot. Fixed costs are next. They shouldn't have that big impact. No. Then we have individual variables. So you can choose any. So now it reads the rows that I just created, so you can change anyone there. Let's take again the average price. Example here from 21, 45 euros per megawatt hour. 10% lower if we would start with 40 euros and 60 cents would still be okay, but not lower than that. And again, if we would raise the price with 10%, the value of the company would be double. Or 20%, it would be double. And there are many of these. You can choose individual indicators, let's say the cost of purchased heat, or you can do volumes, whatever. And what else? Okay, we have different kinds of charts where you can create standard charts, but easier than with just Excel. If we want to see like investments, how they total investments. Oh, here the group rows here again. Investments. I convert negative to positive. So it gives like an overview now of how the investments are over time. So really heavy investments growing here in the beginning and the middle most, and then slowing down and stabilizing the operations, but still keeping some maintenance investment level. Or what else we have? Analysis chart. We have the spider chart and the tornado chart. Let's try the tornado chart. And let's again take investments. We take volume, we take price, we take fixed energy incomes, we take connection fees, we take cost of heat loss, Okay. Let's make a heading. It didn't work like I wanted. We can try. This is included. Fixed energy. Yeah, they were there already. Connection fees. Cost of heat. Fixed cost. Heat produced in our plant. Personnel costs. Other operating costs. That's it, an update. Like this, yeah. So you see the price of the heat to the customer is the one indicator that has the biggest impact on the value of the company. 10% change, almost 4 million impact. Okay, this heat loss multiple has quite a huge impact also, as of course the cost of heat. Then fixed energy incomes, then investments. Investments are not the biggest issue here, although it's very investment heavy, so still the impact is much less than those. And then purchase of heat and then volume. Volume doesn't impact that much because there are variable costs, so that's why it doesn't. And connection fees and other operating costs. Okay. And so on, there is of course also ready-made charts that you can do easily just by a click. You don't have to create them your own. They're already created, and all the charts come as extra sheets in your model. And I notice now that I'm running out of time, and so okay. So if you have any questions or comments, please feel free to address me now in chat or call me later or email me. I will send this case solved to you also. You got the task already, but now you will get also the solved case. So thank you very much for joining, and we stay in touch. Bye-bye.